Okay, this is problem 13.5, and we are going to do some ratios. So they give us what's copied in here is our balance sheet, some data from our current year income statement, some beginning of the year balance sheet data for the ones that we need to do averages. And they'd like us to calculate the current ratio, the acid test ratio, the accounts receivable turnover, inventory turnover, days sales and inventory, days sales uncollected. So I have a ratio sheet out there in Blackboard. If I were you, I would print that out so you always have the formulas in front of you, because really that is the most important thing, is to have the formulas. And then the second most important thing is to know, well, where do I find the information? So our current ratios is going to be our current assets divided by our current liabilities. And I'll just put a little line under there, so that's saying it's current assets divided by current liabilities. So if we go up to the first company, the Barco company, our current assets are everything except for that 290,000. So, I mean, you could either add those up, or I think the easier way to do it is to take the 445,440 and subtract that 290,000. So that leaves 155,440. I can go down. Okay, so 159,440. And again, I'll use that line to indicate I am dividing. But then our current liabilities are the 61,340. And then I'll just put it into my formula, 159,440 divided by 61,340. And that is my current ratio for the Barco company. Now we'll do the same thing then for the other company, the Cayenne company. So again, I'm going to do the same thing I did, though. Take the total, 542,450, minus those plant assets, and that leaves me 238,50. So we'll put that in here, 238,050, and then we'll go back up. We'll go back up to our current liabilities, and our current liabilities for that company are 93,330. And again, I'm going to put the line to indicate I'm dividing, but then we're going to take 238,050 divided by 93,300, and we get 2.55. So this one's a little bit better because it's a little bit bigger. The higher the number, the better. So that one is the best. Then our next one that they want us to calculate is the quick ratio. Or sorry, yeah, the acid test ratio, which is also sometimes called the quick ratio, though. So the acid test ratio is going to be our, we don't calculate any of our inventory or our prepaid expenses. So it's just our cash and our accounts receivable. So 19,000, so cash plus accounts receivable, I guess I'll put that in there. And then we're going to divide that by the current liabilities. So then my cash and my accounts receivable for the first company are 19,500 and 47,500. Did I say 47 or 46? 46. So 66,000 total, and then our liabilities are still the same, 61,350. So again, the math of it will take 66,000 and then divide that by 61,340, and then that gives us a number, and then we'll go up and we'll do the same thing again up here. So we'll go up to the next company. They have 34,000 and 64,600. We'll add those together, 98,600. And then their current liabilities are the same as what we have above, though, the 93,300. Whoops. And then we'll go ahead and put in the formula, 98,600 divided by 93,300. And we get 1.0568. So again, they're close, but this one's just a little bit better. So the higher the number, the better. Then we have our accounts receivable turnover. So our turnover, those require us to do the average. So our accounts receivable turnover is our sales divided by our average accounts receivable. So as we go back up, our sales are over here to the right. So they're 770,000. And then our accounts receivable, the ending balance is the 46,500. And then the beginning balance is given to us here, 29,800. So 46,500 plus 29,800. And then divide that by 2. So add those together. Again, so I'm going to put them in the parentheses and then divide them by 2 to get to the average. Oops, did I put that on the wrong line? Darn it. Let me copy that out. Okay. And then again, our formula is the 770,000 divided by the 31,150. So the accounts receivable turnover is 20.8183 times. Now we'll go up and do the same thing above. So their sales are $880,200. And then their average accounts receivable, their ending accounts receivable is 64,600. And then their beginning accounts receivable is 54,200. So we'll come down to that cell and again use our parentheses. So 46,600, right? Whoops, no. 46, so I have that reversed, sorry. 64,600, go back down. 64,600 plus 54,200, and then add those first, and then divide them by 2 to get to the average. And then our formula, again, is the 880,200 divided by 59,400. So then this one is also the better one. The more it turns over, the better. Then I'm gonna skip to the days sales in inventory, or sorry, the days sales uncollected, because I feel like they kind of go hand in hand, because that's what this one is measuring. It's saying how often am I turning over my accounts receivable, or how long is it taking my customers to pay? So that ties into this days sales uncollected. So the days sales uncollected is our accounts receivable, the ending balance though, divided by the sales, but then the whole thing times 365. Over for this one, but so our ending accounts receivable is the 46,500. The sales are the 770,000, and then I'm going to take that and then multiply by 365, I guess I'll put it in the parentheses. I don't think I have to, but just in case, I will go ahead and do that first. So it's taking 22 days for them to get paid. So that's what that is telling us. And then we'll do the same thing for the other company. So the other company, their ending accounts receivable is a 64,600. Their sales are the 880,200. And again, we're going to multiply that by 365. So then I'll go ahead and put in the formula, and again, I'll use the parentheses just to be safe. 64,600 divided by 880,200, and then times 365. So 26 days. So again, the shorter days uncollected, the better. It means our customers are paying us quicker. And then we have our inventory turnover. And that is going to be our cost of goods sold divided by our average inventory. So if we go back up, our cost of goods sold is over to the right. So 585,100. And then our average inventory we'll have to calculate. So our ending inventory is 84,440. And then our beginning inventory is 55,600. So we'll add those together, divide by 2. 55,600 was correct, right? Let me just double check. Yeah, okay. So we'll add those two together and divide by 2 to get to the average. And that calculates out to be 70,200. And then we'll actually do the math. So 585,100 divided by 70,020 gives us 8.35 times. And then this is going to be one, again, that is the higher the better. Okay, so we'll do the same thing then for the other company. So we'll go up cost of goods sold. So over here, 632,500. And then we'll calculate their average inventory. So go back up. Their inventory is 132,500 at the end of the year, and then 107,400 at the beginning of the year. And then the beginning one was 132,500. So again, add those together and then divide by 2 gives us our average. Then we'll take that cost of goods sold, 632,500, divided by the average, 119,950, and that gives us 5. So again, the first company is better. The higher, the better. Then the days sales and inventory, is that what our other one is? Yep, so our days sales and inventory, again, that goes along with this one. So I kind of like them in a little bit of a different order than what they put them in. So it's very comparable, though, to the accounts receivable that we did up here, except for it is, whoops, I did that wrong way. But then now we take our inventory, our ending inventory balance, and then we're going to divide that by our cost of goods sold. And then we're going to multiply by 365. So then our inventory, it ended at that 84,440, right? 84,440. And then our cost of goods sold is the 585,100. And then we're going to take the, we'll put it in parentheses, 84,440 divided by the 585,100. And then we'll multiply that by 365. So on average, our inventory is in the warehouse for the 52 days, a little over 52 days. Okay, then we'll come over to this one, the next company, and their ending inventory was the 132,500. And then their cost of goods sold is the 632,500. And then we'll divide those and multiply by 360. So the formula is 132,500 divided by 632,500. And again, sorry, I'll put it in the parentheses just to be safe, because we got to do that one first, then multiply by 365. So 76 days is how long their inventory is sitting around their warehouse. So again, the lower amount of time for our inventory to sit in our warehouse, the better. So that is the better. Okay, then that was all that was number one. Then number two, we have our profit margin ratio. So our profit margin is our net income divided by our sales. So we go back up to what they give us up above. So the net income for the Barco company is 162,200. And then our sales are the 770,000. So again, you can go back up there and see that though, but I looked at the other formula. So 770,000. And then our formula is going to be the 162,200 divided by 770,000. And that would be a percentage. So we can make that one a percent. And we can add a decimal if you want to. Okay, then we do the same thing for the other company. So their net income, is 210,400. And then their sales were 880,200. So again, up here in the top corner. And then those will divide. So then 210,400 divided by 880,200 gives us 23.9%. Now that's the better one. Again, the higher the profit margin, the better. So this is that's the first one that the other company did good at. Our total asset turnover is going to be our sales divided by our average assets, total assets. So again, we have the sales right above. So the sales are 770,000. And then our average total assets, we'll have to compute. But so if we go up, our total assets are 445,000. 445,440. And then it tells us here that our beginning balance was 398,000. So then we'll come down here. Again, use our parentheses. 398,000 was the beginning. 445,440 was what it ended at. So we'll add those together and divide by 2. Put in my equal sign so it knows I compute that. So then the average is 421,720. So 770,000 divided by 421,720 gives us 1.825. Then do the same thing for the other company. So again, the sales are right above. The 880,200 is our sales. Our total assets for the other company, the Cayenne company, is the ending assets are 542,450. Then go down to here. Our beginning ones are 382,500. So we'll come down, put in our equals and then our formula. So 542,450 plus 392.50. Let me go back up there. And then we'll divide that by 2. But let me go double check that. 392,500. I could be totally wrong on that. 382,500. So come back down to my formula. Okay, so our average is 462,475. So then now the formula 880,200 divided by 462,475, the average 1.9. So again, the more times it turns over, the better. So that one is a little bit better for the other company. Then we have our return on equity. So our return on equity is going to be our net income divided by our equity. Do they give us a beginning balance? If they do, it's... Yeah, so I guess it's the average equity. All right, so that one is going to be a little bit harder because we got all of those to add together. So we'll come back down to our formula though. So the average equity. So our net income, again, we have that right above there. It's 162,200. But then now our average equity, we're going to have to take our common stock, which is 180,000. And then our paid in our retained earnings, 123,300. So 180,000. But then we also have to add in the beginning year ones. So then those are 180,000 and then 98,300. And then just still divide by 2 because even though it's 4 numbers, these two added together are the total equity at the end of the year. These two added together the total equity at the beginning of the year. So we're still going to, whoops, no, and I don't want you to do that. I want to divide. So we're still going to divide by 2. Okay, then we'll take our formula and it's our net income divided by that average equity. And that gives us a return. So that's a high return. So let's go back up. It's because their equity must be fairly low. Okay, so then we'll go down because again, normally I feel like that's more like around 18,000 or something like that. So that's a high return on equity. Our net income for the other company, again, it's right up here in this profit margin. So 210,400. And then we'll have to do the same thing there. So if we go up to the beginning, or the ending balance, sorry, 206,000 plus the 93,600 is our ending balance. So I'll put that in. And then we're going to add the beginning balances, which again are in that box down below. So then 206,000, is it the same? No, the retained earnings, the 206,000 is the same, but the retained earnings, oh no, I grabbed the, okay, sorry, go back up to the beginning. then so it's 206,000 plus the 142,150. So the common stock didn't change, but obviously the retained earnings did. Okay, so add those all together, and again divide by 2 to get to the average. And then our formula is going to be the 210,400 divided by 323,875. And that is also going to be a higher return. Now, these two you could make, they are percents. And the last thing, and again, there are other ratios though, so this didn't do all of them, but it just shows you how to do them. So you always want to have the formulas in front of you. Now there's one more though. We've got our price to earnings ratio, and they tell us that the market price is $75 a share. And do we know, we can figure out how many shares are outstanding based on what is in that common stock account there. Whoops, sorry. Yeah, and they didn't change, so there's no difference in the weighted average. Okay. So we'll come back down here. So then the first thing we'll actually do is we'll calculate our earnings per share. Then we'll actually have two ratios. So our earnings per share is going to be our net income. There's no preferred dividends to worry about, divided by our common shares outstanding. Then the price to earnings, which is what they're asking us to compute, is our market price divided by our earnings per share. So we got to do both of them to get to that amount. So our net income, again, for the first one is the 162,200. So again, I'm just pulling that from the ratios above, but it's also up here in the table. And then our shares outstanding. So I'm going to go down to the balance sheet. We have 180,000 in common stock, and then it's $5 par. So then if I take the 180,000 and I divide it by the $5 par, that gives me my shares. So then 162,200 divided by 36,000 shares gives us $4.50 per share. And then we'll do the same thing to the other company. So their net income was 210,400. And then we will divide that by their shares outstanding. So again, go up. The balance sheet shows me that there is 206,000 shares. Beginning and ending are the same. And it's also $5 par. So we'll come down here and say 206,000 divided by 5 gives us that many shares outstanding. And so 210,400 divided by 41,200 gives us earnings per share of that. So again, that is also a better ratio. Then finally, then our earnings price to earnings, if we go back up, it tells us that assume that each company's stock can be purchased for $75 per share. So it's going to be the same price. So 75 divided by the 4.05, whoops, sorry, 4.50, maybe we'll make it a 1 just to, or we'll just do 506. We'll go out that many decimals. How about that? Okay, so then we'll say, okay, 75 divided by 4.506. So again, I was getting that just from up here because the earnings per share is the bottom part of this computation. So then the price to earnings is 16.6. Then the other one, the market price is the same, $75. Their earnings per share are a little bit higher. We calculated it right above there. So 5.107, if I round it to the 3 decimals like I did to the other one. So 75 divided by 5.107 gives us 14.658685. So then the market in general has a little more confidence in this first company. And again, a lot of their ratios were stronger. The first, number one, almost all of the ratios were stronger in that first one. And then number two, they kind of started to switch over to the other company. So again, but they were all very comparable. And even even these last two numbers are pretty comparable. So that is the ratios. So again, if you have the formulas in front of you and then you just understand where you find the values, whether they're on the balance sheet or the income statement, that's really all you're doing, is just following what the formula is, find the numbers, solve for it. So that is it then for the financial ratio analysis.